Hi there, my name is Showit and this is Finance Central. In this video, I'm going to explore what a stock is. When you talk about buying a stock in the stock market, what are you really buying and why? I'll go over a simplistic explanation of how a company raises money from founding and how once it goes public, its stock price can fluctuate. As usual, please like this video and subscribe to my channel if you find value in the type of videos I'm putting out, so that it will help the YouTube algorithm serve them to others. Also, please leave a comment below if you want to suggest topics on which I should make videos. With that, let's get started. According to Investopedia, a stock is a security that represents the ownership of a fraction of a corporation. When a company is founded, 100% of it is owned by its founders. As the founders seek investment to fund their research and development, operations, and/or scaling, there are practically two options. One is to fund it using debt or to fund it using its equity. When they use debt, they are taking out a loan against the company at a set interest rate, and the entity that gives them this loan will probably be first in line to claim assets in case there is a liquidity crisis or a bankruptcy. The company then must make interest payments on this loan whenever it comes due. The other option is to give up a stake in the company in the form of equity to angel investors or venture capitalists in the early funding rounds at a mutually agreed upon valuation of the company. The value of the shares increases as the company makes progress on the technology, gains more customers, increases profits, and provides more economic value. Even with a small stake in the early stages, the owners of the equity can make a lot of money as the company succeeds. A time comes when some or all of the investors may wish to exit their position in the company, or a large amount of funds may need to be raised in the public markets. This can be done in a few ways, but the most popular way is to have an initial public offering, that is, an IPO. An investment banking firm will value the company's stock at a certain price, and it will get listed on the stock exchange for all to buy and sell. In the secondary markets, which are assumed to be efficient, the value of the company will depend on the public information available as people freely trade. As the company innovates by serving new customers in new markets or scales their processes with higher demand, the secondary market is able to use this publicly available information to analyze the company and change its valuation. The company can then raise more funds by issuing more stock at the market price and lead to some dilution. But in the long run, if the company keeps up with innovation and demand, its valuation and stock price are bound to increase. The perks of owning a stock are that you can participate in some of the decisions a company makes. Just to be clear, what you have in the secondary market is common stock, which is last priority in case there is a bankruptcy, even to get paid any dues. So please do your due diligence in case you wish to invest in a company for the long run. The way you gain from owning a stock is by selling the stock once the stock price is appreciated, or from dividends the company pays out if it's a dividend-paying stock. Let us look at two company stocks in the past 30 years. Number one is Apple and number two is GE. As of the making of this video in early 2021, Apple is the most valuable company in the world with a market capitalization greater than $2 trillion. And on the other hand, GE is a company that peaked in value more than 20 years ago in 2000. This shows you that not every company can continue its trajectory of growth, and with changing times, a company that is more flexible will be able to grow. There are many factors, including leadership, vision, industrial sector, expertise, etc., that will play major roles in the success of a company. Every quarter, a public company will have a quarterly earnings call that will give you information about its profits or losses. Along the way, there will be other press releases about projects the company is working on, as well as leadership changes. If there are acquisitions or mergers, these will also be part of the earnings statements. Analysts that focus on the company will provide price targets and give a signal as to which way they expect the company to go. Ultimately, it is the people who own the stock whose decisions to buy, hold, or sell will lead to these price changes. For some of the larger companies, it is beneficial to be included in some of the popular index funds. So as people look for diversification and invest in these index funds, the company benefits from that as well. The overall stock market is more complicated than what I have been able to include in this video, with institutional investors, hedge funds, and other things like shorting, call and put options, day trading, etc., affecting the day-to-day price changes for a company's stock. But we're talking about being a long-term investor, which is for the time period greater than 2 years. If you believe in the executive team of a company to make good decisions for the future of this company, to be able to attract great talent and fund the right projects, put out amazing products that shape the way we live our lives as a society, then the company deserves your investment. The average investor like you and I do not have the time to keep up with the information about the companies we invest in. The general advice is to diversify and not put all of your eggs in one basket. The more you diversify, the more difficult it is to keep track of the companies on a day-to-day basis. In that case, we depend on reading analyst reports or just earnings calls every once in a while to make sure that we still have confidence in the future of the company. There is a lot of research that happens before an executive team decides to fund a project at the company, and it is almost impossible for the average person investing a small portion of his or her portfolio to dive deep into the strategy of the company, and so it is so difficult to predict where the stock price will be in the future. In future videos, I plan to dig deeper into some of these topics, so please be subscribed to my channel to not miss those. That is it for now. Goodbye, and I hope you have a wonderful day ahead.